So good morning, David.
Good morning, James.
Thank you very much for doing this again. It's about a
Yes.
year since we last talked to you on Henderson.
Pleasure.
As usual, though, I think, although you've done this before, it might be good just to sort of start off with an introduction to the fund. So if you want to run through the slides you gave me, that would be quite helpful. Thank you.
Yeah, sure. So if you, James, if you move on to the first one, that's right. So Henderson High Income, I tongue-in-cheek kind of describe it as the Ron Seal of Investment Trust, because effectively it does exactly what it says on the tin, i.e. to produce that high level of income to shareholders, but also the prospects of capital growth into the longer term. And you can really see that on the chart on the right-hand side there, just showing the red line shows you what the dividend yield of the trust is. And although we've seen obviously a spike higher in bond yields, in savings rates, etc., the trust still trades at significant yield premium to all those other asset classes. And I think one thing that really differentiates this trust from competitors really is it's the fact that it's an equity and bond investment trust. So typical split would be 80% in equities, 20% in bonds. Majority would be UK, but we can own up to about 30% overseas. If you go to the next slide, James. In terms of the key attributes, so it is a well-established trust. It was launched back in 1989, and we generally have a long-term approach in terms of the companies we own. So a typical holding period would be between, say, 3 and 5 years. And we're really focused not just on companies that pay a high dividend yield, but also ones that can sustain that dividend clearly and grow it into the longer term. And I'll sort of come on to talk about the importance of that in a little bit. I do have a strong, we do at Janus Henderson, who run the fund, we do have a very strong income heritage. So I sit alongside the likes of Job Curtis, who runs City of London Trust. I sit with James Henderson and Laura Fole, who run Lowlands and Lord Adventure, and obviously Alex Crook as well, who runs Bankers. The trust has obviously delivered a high dividend income over the last 10 years or so since I've been on the trust. But one of the other things we've done is also generated income growth for our shareholders. So last year we delivered our 10th consecutive year of dividend growth, and over that period that dividend has grown by 2% compound average growth rate. So delivering on a high income, but also given a little bit of dividend growth to shareholders as well. Next slide, please, James. Now I talked about obviously our unique structure, having the ability to own bonds, and I think one of the things that people need to get comfort on is the gearing, and because there's a structural element to that gearing. So i.e. The bond portfolio is funded by the majority of the gearing within the trust. So where I've got fixed rate borrowings and essentially with an interest cost of 3.7%, and invest that in a broadly stable portfolio of bond assets yielding closer to sort of 5.5–6% currently, actually that's a good way to generate that extra income for the trust. Once you strip out that element of structural gearing or the gearing that funds the bond portfolio, actually the gearing towards the equity portfolio is around about 8.6%, as we are at the sort of end of May there. So that's more the sort of traditional way of thinking about gearing within equity trusts as well. So although there is at the headline level, the gearing level maybe look optically relatively high to maybe some of the other UK equity income trusts in the wider sector, actually because we got the ballast, because of that majority of that gearing is backed by a more stable portfolio of bond assets, actually, as you can see on the chart on the right hand side there, the overall volatility of the NAV is not that too dissimilar to the wider UK equity market. So what I always say, just because it looks a relatively high geared trust, actually because of the makeup of the underlying assets that we own, actually the overall volatility isn't as high as you would normally expect from that. And that's the one thing, a sort of key message I always tell investors or potential investors to hopefully give them comfort on that. In terms of what we look for, in terms of the companies that we own, typically, I kind of split the investment process into 3 parts. So firstly, it's all about fundamentals, really understanding what a company's key attributes are. And I think, we have a bias towards good quality companies, whether that be companies that have robust, understandable business models, that we want them well positioned in their markets, to have strong brands or franchises, and good quality management teams as well. And I think, taking a step back, it's about, finding companies which are hard to compete against, and ones that can't be competed away, whether that's from traditional competition or new technology companies, etc., disintermediating them away. We want our companies that we own to be around in 10 years' time, and to be bigger as well. Then we look at the financials of a business, really analysing the financial health there. How sustainable are the profits? Are the companies investing enough in their own assets to grow over the longer term? How strong are the cash flows? Because essentially we need strong cash flows to be able to pay those dividends. And also robustness of balance sheets. So, one of the key things that we really look for is that strength of balance sheets, because all companies will get into trouble. Whether it's the cycle, etc., or a slowing economy, etc. But making sure you have a strong balance sheet means you can, survive those more difficult times and hopefully thrive in the longer term when recovery comes. We also look for companies that have sensible dividend policies. Just because we're an income fund manager doesn't mean we want all the cash flow paid out for income. We want to make sure that our companies are invested enough to grow their businesses, because ultimately that growing free cash flow means that dividend is not only going to be sustainable, can grow into the future as well. And then the third part of the investment process is really about valuation. It's all very well finding a good quality companies with good or improving financials, but if it's already discounted in the valuation, then actually your capital appreciation is much more limited. So it's about finding good quality companies that have got good or improving financials, but being very disciplined on that valuation to make sure you are buying them at cheap valuations or below where you think the intrinsic value of those shares are really. Next slide, James. Now, I talked earlier about the importance of sort of dividend growth and dividend yield, and I think these two charts really sum it up for me. The chart on the left-hand side there, that it's kind of split down between sort of dividend yield range over history, and what it tries to show you is that the black bars show you what you expected to receive in terms of dividend yield, and the orange bars show you what you actually received at different levels of dividend yield. So as you can see, that the higher the dividend yield, or the further right you go on the chart, actually the less likely you are to actually earn that dividend yield. And that's because higher dividend yields area of the market typically are companies that can't sustain those dividends, and they're typically value traps. That's why we kind of look for companies that can, or that have a dividend yield range of between, say, 2 and 4 and 4 and 6%, because actually that's historically where you find dividends are much more sustainable. If you look on the chart on the right-hand side, which looks at total returns at different dividend yield levels, that 2 to 4% range and that 4 to 6% dividend yield range actually produces the best total returns over the longer term. That's because it's, the value of a company is really driven by not just the dividend yield it pays, but the dividend growth it produces as well. So those two combined make up the majority of your total returns. And clearly those companies that pay a dividend yield between 2 and 6% obviously give you good dividend growth at the same time as well. And I think it comes back to kind of the overall structure of the trust, having our ability to utilize gearing, have an ability to own bonds to boost that headline dividend yield for shareholders, means that actually within the equity portfolio, I don't have to be too far up the risk curve, really chasing those higher yielding areas of the market, where, like I said before, you get more dividend cuts, where you get more value traps, etc. So I can focus on businesses that can generate good dividend growth, and hopefully good capital appreciation at the same time. Next slide, please, James. So that was very much a sort of brief introduction to the trust. I suppose I'll talk a little bit more about sort of market outlook going forward. And, I guess the key debate at the moment, certainly in the UK market, is inflation. Clearly we're in a high inflationary environment at the moment. And whereas you're seeing, certainly in the US at the moment, where inflation is starting to fall from those very high levels, actually it seems to be quite stubbornly high in the UK. What this chart tries to show you is some of the lead indicators we look for inflation. So, the orange bar shows you broad money, which is effectively just the amount of money that is circulating in the economy, in the UK economy. Clearly, as interest rates go up, there should be less money in the economy swashing around that's driving inflation. So these are typically lead indicators. So as you can see, the orange line there has started to fall quite rapidly. Likewise, the blue bar, which is producer output prices, i.e. the goods that manufacturers are making, what prices they charge. And again, you're seeing disinflation pressures coming through, which are generally good lead indicators. So it does feel like inflation is going to fall from the high levels that we're seeing in the UK. Next slide, please, James. But then the debate moves on to where does inflation settle? The chart on the left-hand side there, it's called the five-year swap rate, but effectively what it shows you is what people think 5-year inflation will be in 5 years' time. So it's a guide to where people in the market expectations are for long-term inflation. And I think it's safe to say that the market expects actually inflation to remain higher than where we've been historically, and certainly above that Bank of England 2% target that they have out there. And there's reason to suggest why inflation should be higher going forward. Tight labour markets, certainly in the UK. Unemployment is very low at the moment. You're seeing wage inflation come through, and I think that actually because of some of the curbs on immigration, etc., I think that could continue. Deglobalization, globalization over the last 30 to 40 years has really driven inflation lower. I think you're starting to see, moves the other way. Governments are being a lot more protectionist right now. You're starting to see barriers to international trade, etc., which again will lead on to higher prices in the longer term. Onshoring, I guess, is similar arguments to deglobalization. So post the pandemic, you are seeing this move from companies to bring manufacturing sites more closer to the home markets. Certainly in the semiconductor industry, we're seeing a lot of the US semiconductor manufacturers actually bringing capacity back from Asia, where it's been cheaper, and building facilities close to home in the US, etc., where actually because of those supply chains got so disrupted in the pandemic, etc., actually it's better to have a certain amount of capacity closer to your home market. Again, that's likely to be inflationary. And I guess the last point is the amount of investment that needs to go into green infrastructure. There has been this push towards net zero, investment in wind farms, solar farms, etc. And actually, given the war in Ukraine, actually it's accelerated that move from for governments and countries to think about investing more to become more secure in terms of their energy supply. So I think that's going to be inflationary as well, given the amount of investment that's probably chasing scarcer resources there as well. So putting that all together, I think it does mean that interest rate, we're now in a different era, really. I mean, over the last 15 years, we've been in a period of ultra low interest rates. I think that's changed now. I think we are going to go through a period where interest rates are likely to stay higher for longer. And that's not necessarily a bad thing. So James, if you go to the next slide, the chart, I'm sure most of you are probably aware how much the UK has underperformed global markets. You can see it there on the left-hand side there. So, that the black bar is the FTSE All Shares total return, and the orange bar is the MSCI World ex-UK. And obviously you can see a material underperformance there while we've been living in that sort of ultra low interest rate environment. And I think ultra low interest rates has been the real boom of US tech. I think that's been the key driver of the global indices you see on the chart there. And it makes sense. So when we've been living in a low growth world, people are happy to pay higher valuations for companies that can deliver good growth. So clearly US tech has been delivering that good growth, and it has been a case of valuations haven't really mattered. You just want to be buying companies for whatever valuation, and just because they can deliver you better growth. I think in a world where interest rates stay higher, where your hurdle rate is so much higher, I think valuation becomes much more important. And actually, we can see from the table is historically when interest rates have been higher, whether it be in the 70s, 90s, early 2000s, actually it's been a case where value has mattered. And the UK market, which is typically a more value-based market, has actually outperformed global indices. So actually the last 15 years or since the global financial crisis, actually that's been the exception to the not the rule in terms of what sort of style and what sort of markets have generally outperformed. So I think if you believe that we are going to stay in this sort of higher for longer interest rate environment, then actually that could be the catalyst that the UK does well. You know, I've probably been boring investors for a while saying the UK is cheap, and everyone said, what's the catalyst? What changes that? Actually, I think higher for longer interest rates will change that. Next slide, please, James. So yeah, so I just said it obviously just then about the valuations in the UK market, and the chart on the left-hand side there kind of shows it nicely. You know, valuations are cheap in the UK market across the market cap scale. So whether it's the mega caps of the FTSE 100 or the mid caps in the FTSE 250, PE ratios are back down to sort of levels we haven't seen, you know, since the GFC or the Eurozone debt crisis back in sort of the early sort of 2011, 12 there. The chart on the right hand side one is one I stole off a strategist from Liberum actually. He looked at what valuation the UK market is traded on in terms of PE, price earnings ratio, relative to history and different inflation ranges to try and work out, you know, what level of inflation is the UK market discounting. And what's interesting to me is that if you believe inflation is going to fall, which I think, you know, as we suggested on the earlier slide there, it does feel like it is going to come down at some point. But even if it remains higher than the 2% average from the Bank of England's target rate, actually the UK market can still do well in that environment. It should re-rate. If you look at history, actually where we trade currently, it seems to be implying that inflation is going to stay higher forever. I just don't think that's going to happen given the falls we've already seen in energy prices, etc., and other, you know, food prices starting to come down as well. So if you think inflation falls below that sort of 5.5% level, then actually there could be a re-rating story for the UK market as well. Next slide, please, James. So I very much talked about macroeconomics and market and valuations, etc. I always prefer talking about stocks because that's kind of more the day job. So this slide just talks about sort of two of the new additions we've put into the portfolio this year. So the first one is Money Supermarket. So this is obviously the price comparison website. The chart above the logo there, just on the left-hand side, just shows you motor insurance quotes. So if anyone's like me, I got my quote through for my car insurance a couple of months ago, and Direct Line were putting up by 90%, which I almost fell off my chair at the time. And I think what you've seen historically at high rates of inflation for car insurance and home insurance, etc., you see much more switching. And that's going to be the boom for moneysupermarket.com. You know, clearly the market leading price comparison website. It's a good business model. It's got high gross margins. Given the CapEx requirements are fairly low, it's got a very free cash flow and a pretty attractive dividend as well. So, you know, it's one we've liked. We think, you know, it's been in the doldrums for a while because switching, you know, because of low motor insurance prices, actually there hasn't been much switching. I think that dynamic where you're seeing high premiums coming through and high inflation, you're going to see much more switching come through. Also on the energy side, obviously, given energy prices being very high, given there's been government subsidies, etc., there's been no switching in the energy side. Again, as we see energy prices fall, I think actually now you'll start seeing energy switching and people looking for more to fix their rates going forward. And none of the analysts has got that any sort of profit contribution from that side of the business as well. So I think that's a free option there as well. The next new addition is DCC, which is a distributor. So one of the main divisions in the business is distributing gas and oil to homes that are not on the grid. And the chart on the slide there just shows you the D rating. So this is a valuation that the shares trade at, and as you can see, it's hugely derated over the last 5 years of where it traded at high teens PE down to less than 10 times now, and that's because of the fear that you know, what happens to the business as people move away from traditional fossil fuels to more renewable energy, etc. You know, and I think what the market is missing is the company has a very clear energy transition strategy. So for them, it doesn't really matter what fuel they are distributing to their own customers. Whether it's oil, or whether it's LPG, which is a gas that's lower emitting, whether it's biofuels in the future, whether it's hydrogen, these are renewable gases, etc. They can distribute that through their current existing infrastructure with minimal capex requirements. So it's a business that has a credible transition strategy. It needs a limited amount of capex to execute that strategy. And yet it should be able to deliver, therefore, its continued high returns on invested capital that we've seen historically going forward, which is clearly, given the derating we've seen in the shares, is clearly not being priced in. So very strong balance sheet, delivers high returns. Again, another attractive yield that has been growing and continues to grow. So it's got a 29-year track record in terms of dividend growth. We think that continues going forward, which again, we don't think is discounted in the current valuation. Next slide, please, James. Final slide, I probably won't talk, but I'll sort of leave it up there, just looking at the current position in terms of sector exposure and our top 10 holdings there. But I'll probably pause there and answer any questions that James or any of you listeners have, really.
Thank you, David. That's very helpful.